I need to tell you about a man I'll call David. In March 2024, David read an article in The Telegraph titled, "The 10 Best Buy-to-Let Hotspots in the North." Number 3 on that list was Stoke-on-Trent, specifically, the area around Hanley. The article cited massive regeneration investment, improving rental yields of 7%, and northern property prices still 40% below southern equivalents. David, a software engineer from Reading, had £80,000 saved for investment. He'd been priced out of the south. So he bought 2 properties in Hanley for £75,000 each. Total investment, £150,000. 9 months later, both properties are in negative equity. He's lost 3 tenants. The so-called regeneration has stalled because Stoke City Council is effectively bankrupt. And he can't sell, because there are now 94 similar properties listed in Hanley, and none of them are moving. David has lost everything. And the Telegraph article that convinced him to invest? It was sponsored content paid for by a property developer who'd already sold their Stoke portfolio and wanted to exit before the collapse. Today, every property website, investment blog, and buy-to-let guru is publishing their best places to invest in the North and Midlands for 2026 lists. And I'm going to show you why every single one of them is a trap. Because the North and Midlands aren't on the verge of a boom. They're on the verge of total economic collapse. And the people telling you to invest there are either catastrophically ignorant, or they're trying to offload their own failing assets onto you before you realize what's happening. The lists nobody should trust. Let me show you what's currently being published. Rightmove, top 10 northern cities for capital growth in 2026. Zoopla, where smart investors are buying in the Midlands. Property Investment News, the Northern Powerhouse, 15 towns poised for explosive growth. And every single one of these lists mentions the same places: Liverpool, Manchester, Birmingham, Nottingham, Sheffield, Leeds, Newcastle, Stoke, Wolverhampton, and Derby. Now let me tell you what these lists don't mention. Liverpool, the city has 4,200 empty commercial properties and the 4th highest unemployment rate in England. The Liverpool Waters Regeneration Project, the one they keep citing, has been scaled back by 60% due to funding collapse. Manchester, there are currently 11,400 new build apartments under construction or completed but unsold in Greater Manchester. That's a 340% oversupply compared to annual demand. Prices in Salford Quays have dropped 23% since 2022. Birmingham, the council is bankrupt. Youth unemployment is 18%. The HS2 terminus, the regeneration anchor they promised, has been cancelled. Property transactions in Q4 2024 were down 41% year-on-year. Nottingham, the city council is on the edge of bankruptcy. They've sold off £400 million in assets to avoid a Section 114 notice. Rental yields have collapsed to 4.1% gross as students move to cheaper cities. Every city on those best investment lists is either in crisis or heading into one. But the lists don't tell you that. They tell you about emerging opportunities and value gaps. The rental yield illusion. Here's how they trick you. They'll say, average rental yields in Stoke are 7.2%, compared to just 3.1% in London. That's a 132% higher return. What they don't tell you is that rental yield is meaningless if you can't find tenants. The tenants you find don't pay. The property value collapses faster than you collect rent. Let me give you the real numbers from Stoke-on-Trent. Yes, the gross rental yield looks like 7.2%. But factor in void periods averaging 11 weeks per year, up from 4 weeks in 2022. Tenant arrears and eviction costs averaging £2,800 per property annually. Maintenance on aging Victorian terraces averaging £3,400 per year. Letting agent fees, insurance, and compliance costs. Your actual net yield? 1.9%. And that's before capital depreciation. Properties in Hanley have lost an average of 9% in value since January 2024. So your total return is negative 7.1%. But the investment lists don't show you that calculation. They just show you the 7.2% gross yield and tell you it's an opportunity. The Stoke catastrophe. Let me take you through what's actually happening in these so-called investment hotspots. Stoke-on-Trent was supposed to be the regeneration success story. In 2019, the government announced £56 million for the Ceramic Valley regeneration. Property developers bought up hundreds of terraced houses. Investment gurus started recommending it. But here's what happened. The regeneration funding was cut to £31 million in 2022. Then to £18 million in 2024. The flagship project, a cultural centre in Hanley, has been indefinitely postponed. Stoke City Council announced in October 2024 that they are facing a £40 million budget shortfall. Meanwhile, 3 major employers have left. Bet365 reduced their Stoke workforce by 1,200 jobs, Michelin closed their factory with 600 redundancies, and Jaguar Land Rover cut 800 jobs from their engine plant. The result? Property prices in Stoke have dropped 11% in 18 months. Rental demand has collapsed. And landlords are trapped. I've seen properties in Fenton listed for £68,000 that aren't selling. 3 years ago, they'd have sold in a week for £85,000. Now they sit for 9 months, 11 months, 14 months. Because everyone who was going to buy has already bought. And now they're all trying to sell. The Sheffield oversupply crisis. Now let's go to Sheffield, another city that appears on every best investment list. Sheffield has been building student accommodation at an insane rate. Since 2020, developers have added 8,700 purpose-built student beds. But here's the problem. Sheffield's student population has actually declined by 4% since 2021. So what happens? Rents drop. In 2022, a room in a student property rented for £115 per week. In 2024, it's £89 per week. That's a 23% rental income collapse in 2 years. But it gets worse. Because Sheffield's student accommodation boom was financed by small landlords who bought off-plan apartments in new developments. They were told, guaranteed 6% yield for 3 years. But those guarantees are ending in 2025 and 2026. And when they end, landlords will discover the real market rent is 30% to 40% lower than what the developer promised. And they can't sell. Because who's going to buy a studio apartment with a 3.2% yield when you can get a savings account paying 4.5%? The Nottingham bankruptcy bomb. Let me finish this section with Nottingham, a city that still appears on investment lists despite being on the brink of financial collapse. In November 2024, Nottingham City Council sold off their energy company, Robin Hood Energy, at a £38 million loss. They've sold their stake in Nottingham City Transport. They've sold off council buildings, parks, and community centres. Why? Because they're trying to avoid bankruptcy. And what happens to property prices when a council goes bankrupt? Let me show you. Since the bankruptcy warnings began in mid-2023, property prices in Nottingham have dropped 7% citywide. But in specific wards, like Bulwell and St Anne's, they've dropped 12% to 15%. Transaction volumes have collapsed. In Q4 2024, only 340 properties sold across the entire city. In Q4 2022, it was 890. Nobody is buying. Because smart investors know what's coming: service cuts, council tax increases, business closures, population decline, and further price drops. But the investment lists don't mention any of this. They just say, Nottingham, strong rental demand from 2 universities. The developer exit strategy. So who's actually behind these best places to invest lists? Let me introduce you to a company called Fortis Developments. Fortis spent 2019 to 2022 buying up cheap terraced housing in places like Stoke, Burnley, and Blackpool. They renovated them to basic HMO standards and sold them to buy-to-let investors at 20% to 30% markups. Their marketing was brilliant. They'd publish reports with titles like The Northern Renaissance, Why Stoke Will Outperform London. They'd sponsor content on property blogs. They'd pay investment influencers to promote their developments. And it worked. They sold over 800 properties between 2020 and 2023. But here's what's beautiful about the scam. Fortis exited their entire Stoke portfolio by March 2023. They sold every property they owned. And then, 6 months later, the market collapsed. The investors who bought from Fortis are now sitting on properties worth 15% to 20% less than they paid. But Fortis? They're fine. They've moved on to the next city. This is the pattern. Developers buy cheap, create hype, sell to retail investors, and exit before the collapse. And the best investment lists are the marketing vehicle. The data manipulation. Now let me show you how they manipulate the data to make these places look attractive. Take Liverpool. Every investment list cites 7% average rental yields and improving employment figures. But here's how they get those numbers. The 7% yield is calculated using asking rents, not achieved rents. If you list a property for £800 per month but only get a tenant at £680, your actual yield is 15% lower than advertised. And the improving employment figures? They're using a dataset that counts 0-hour contracts and part-time gig workers' employment. The actual number of full-time jobs in Liverpool has declined by 3% since 2022. But property developers and investment platforms don't correct these numbers. They just cite them. Because inflated numbers drive sales. The institutional landlord endgame. And here's who benefits when you fail. When small landlords like David buy properties in Stoke and then can't afford to maintain them or cover void periods, they're forced to sell at a loss. And who's ready to buy? Lloyds Banking Group Residential Investments, Granger plc, Sigma Capital Group. These institutional landlords are sitting on billions in capital, waiting for distressed sales. They're buying up entire portfolios of failed buy-to-lets at 20% to 30% below the prices small landlords paid. Then they either convert them into build-to-rent units with professional management, or they sit on them and wait for any future recovery. Either way, you lose. They win. What investment opportunity really means. Let me translate what these best places to invest lists are actually telling you. Affordable entry prices equals nobody else wants to buy here. High rental yields equals property values are collapsing. Regeneration investment equals government funding that will be cut. Emerging market equals no established demand. Value gap versus London equals there's a reason it's cheap. If an area were genuinely a good investment, institutional money would already be there. The fact that they're trying to convince you to invest means the smart money has already left. The 2026 Northern Recession. Here's what's actually going to happen in the North and Midlands in 2026. Council bankruptcies will accelerate, Nottingham, Birmingham, Sheffield likely by Q3 2026. Commercial property vacancy will hit record highs. Youth unemployment will spike as public sector jobs are cut. Rental demand will fall as young professionals leave for the south or emigrate. Property prices will drop another 8% to 12% in secondary cities. Small landlords will flood the market with distressed sales. And the people who bought in 2024 and 2025 based on those best investment lists? They'll be trapped in negative equity, bleeding cash on void periods, and unable to sell. Do not invest in the North and Midlands in 2026. My advice is brutally simple: stay out. If you're being told that Stoke, Nottingham, Sheffield, or any secondary northern city is a great opportunity, ask yourself, who profits from me believing this? Because it's not you. If you want to invest in property in 2026, wait. Wait for the council bankruptcies. Wait for the distressed sales. Wait for prices to find their true bottom, which they haven't yet. And if you're already invested in these areas, consider your exit strategy now. Because every month you wait, you're competing with more desperate sellers. The only real opportunities. If you absolutely must invest in 2026, here's the only advice I'll give. Focus on primary locations with genuine economic fundamentals, places with diverse employment, low council debt, and actual population growth. That's a very short list, and it doesn't include the cities on those best investment lists. Or better yet, keep your cash in a 4.5% savings account and wait. Because the opportunity isn't in buying at inflated 2024 prices. It's in buying at distressed 2027 prices after the collapse. Final thoughts. Every best places to invest list you see is a marketing document, not financial advice. The people publishing them either don't understand the data, or they're deliberately misleading you. The North and Midlands are not on the verge of a boom. They're on the verge of a reckoning. And the only question is, will you be holding the assets when it happens, or will you be the one buying them after the smart money has already left? Share this video. Send it to anyone thinking about investing in property in 2026. Because the only way we stop this cycle is by refusing to be the exit liquidity for developers and distressed sellers. This is the truth about northern property investment. And it's a truth the industry doesn't want you to hear. I'll see you in the next one.